Hello and welcome. This is the Mutiny Investing Podcast. This podcast features long-form conversations on topics relating to investing, markets, risk, volatility, and complex systems.
So it's my pleasure today talking with Jerry Parker at Chesapeake Capital, a man who has over 4 decades of experience trading the markets. And to me, success is always defined by survivorship. So Jerry has that in spades. At Chesapeake Capital, they have a motto that they're 100% trend following plus nothing. I think that's a fantastic motto, but it begs the question, what is trend following?
Oh, well, that's a very good question. What is trend following? I always debate this. What is trend following? What is classic trend following? It recently got called caveman trend following. Sticking to the basics: one entry, one exit, and a stop loss. That I think is a pretty good way of looking at it. And which, obviously most CTAs trade lots of markets, longs and shorts, currencies, commodities, stocks, bonds. Probably most systematic, but it's rare to find that sort of a trend following, pure trend following, because most CTAs over the years have added features, or I would say maybe negative features to the classic trend following, not just some short term or things that are complementary trend following, but they've kind of watered down the trend following some for some heavy-handed risk management overlay or volatility targeting, things like that. Which I have tended not to do over the past 37 years.
It's amazing. So it's called trend following, it's called CTA, it's called managed futures. There's a lot of names, which means it's still, to me, searching for a name that really catches on with the outside audience. But in general, if we start with basics, trend following is trading a diverse basket of asset classes, whether it's FX currencies, bonds, equities, commodities, and trying to diversify across as many asset classes as possible. And the idea from trend following comes, you buy a breakout or a moving average. So a lot of times you're buying on a high and selling even higher, or you're selling on a low and buying back even lower. And that goes against a lot of people's natural tendencies or what they've learned as far as mean reversion. And part of that is, you have tight stops when you open the trade, and then you might have open or trailing stops when you have a trade on. So what that does is that strategy in general allows for a right tail skew of your P&L. And so you may make a lot of small bets where you're getting stopped out, but you're just trying to capture those big returns. Did I do a fair assessment of that in general, or how do you think about it?
I mean, actually, it's as good as I've ever heard it, especially recently. So you're hired. I think another thing too, take small losses and let your profits run. I think people are pretty good at taking small losses. You don't want the loss to be too small. An optimal small loss, let's say. We don't want to get whipsawed in and out. I think 40% winning trades is a good goal. If your stop is too tight, it may be 20% winning trades. So I like to sort of optimize that number and get it in that sort of low 40 range. But I think the other part we have more trouble with as a group, and that is letting our profits run. I think that is pretty scary and rare these days in a pure sense. I think people say that they do it, but I don't think they really do it very much. I was just looking at the markets, and I've been in this lumber trade, and we've made a lot of money in lumber and in Bitcoin, Tesla. There's a lot of good trends, soybeans, and now lumber is down limit for the second day in a row. And so, it's really difficult to sit there with that lumber trade and not peel it back for different reasons. Volatility got high, or just you got a profit objective or something like that. But I think it's really difficult to say, you know what, I'm going to be very conservative and very cowardly with my losing trades, but I'm going to be bold and let those profits go and wait for my trailing stop, which could be, like you said, a breakout or a moving average. And I think that's where the difference really is how bold and brave can you be and let those profits run. I think another thing that's happened in my time in the industry has been to turn your back on that philosophy and introduce sharp and volatility and other kind of risk metrics that pretty much just serve as a way to take profits and make yourself feel better because I'm managing my risk. And whereas we're already managing risk with the first part of that cliche, which is take small losses. And we're, as you said, so diversified with shorts. How can you get more diversified than their typical CTA? But like I said, it's letting those profits run come hella high water without any excuse. That trend following plus nothing, it's so hard to do because we don't like to give back profits. And the world keeps telling us that volatility equals risk.
And so I love that, the world tells us volatility equals risk. And we'll come back to vol targeting and where maybe CTA or managed futures has gone a little astray in the last few years. But you did bring up something with the lumber trade that I want to maybe point out really quick if somebody's not used to trading futures, is you said they were limit down, but also how many days in a row has lumber been limit up? And maybe you can describe what limit up and limit down means in futures markets.
Yeah, so there's a preset amount that the exchange will allow the market to move in any day. And as something like lumber continues to go up over the past months like it has, I think they kept expanding that maximum amount that they would allow it to go up or down. And so I talked to my trader a few minutes ago, and he said, by his count, 18 of the past 21 days, July lumber has either been limit up or limit down. So, it's just one of those things you have to live with. But come on, we can live with it because I trade 100 markets. It's a small position, relatively speaking. And that's kind of where you want to be in the world and in trading and managing money, is you kind of don't want the ability to make money in a market unless it really goes a long way. And then likewise, you can't get hurt too bad in a market unless it really goes against you. And so, but now we're getting back to this idea of I can pretty much assure almost every single time that when I put that lumber trade on, I had a predetermined stop. I was going to risk 50 basis points of my assets. And now that it's been a huge profit for so long, months and months, when it has these negative days, I'm not really counting that as a loss. The trade is more than likely going to be hugely profitable. So I'm just trying to take that benefit that trend following gives me and says, hey, just loosen up, lighten up, relax a little bit. It's a profit. There's no reason to get too uptight. Just in order to maximize that profit, you will have to allow the market to have a lot of volatility and possibly give back, some of that open profit.
Yeah, what I think about a lot of times is people, when they're learning about markets, I have a general theory that they either learn from like Warren Buffett or they learn from market wizards. And if you learn from market wizards, you're primarily dealing with a lot of trend followers. And to me, there's for lack of a better term, there's a philosophy to trend following. Like you said, it's that discipline to be able to let your profits run is very difficult for people. But more importantly, part of that philosophy is not knowing where your next profitability is going to come from. Like, could you have predicted that lumber was going to go spike out of control, right? During COVID, everybody thought the world was going to shut down. We were never going to build houses again. But that's the beauty of trend following, is like, could you envision oil going negative? You don't have to, because you're riding the trend. Can you envision lumber being locked limit up for days and days on end? You don't have to, because you're following the trend. It's a deeply philosophical practice at the end of the day.
It really is. And I think, obviously we're banking on that, and the CTAs are expected to make money when things don't make sense and crazy things happen. Interest rates going to zero or close to zero or going negative in Europe and Asia. The CTAs are the only ones dumb enough to stay on that trend. The stock market continuing to go up as valuations explode. I mean, I've been hearing about valuations, I don't know, since 2015, but it keeps getting worse and worse and worse. And so, yeah, I mean, that's our job. And a lot of the money that we've made over the years has been in things we've never seen before, things that these rare events that you just can blindly follow with the trend. And sometimes that's the only way you're going to make money, is just blindly following them with the trends.
I was thinking about this morning. I was thinking about some of like Paul Tudor Jones's trades, or some of these global macro discretionary hedge fund managers. And I was thinking, I wonder if you just didn't describe yourself as a systematic trend follower. If you described yourself as a global macro discretionary trader, then people would think you were like George Soros or Paul Tudor Jones, that you called all these trends when they happened. Is that fair?
I love that. Yeah, I thought about that over the years, especially. Paul Jones kind of called this stock market last year. He has gotten more straightforward about using trend and the 200-day moving average, but he kind of called this thing. We're saying that if Biden wins, then we could have a really big stock market rally. And he said, and if Georgia goes to the Democrats, he goes, it's like even. And I was going, no way. And he says, oh, no, it's like even right now. And if Georgia goes to the Democrats, like nothing would be standing in the way of stimulus and stuff. So I think he has his rules and takes his small losses and tries to diversify and uses the 200-day moving average. And it kind of frees us up, traders who look at the world this way, to have these crazy opinions, this cocktail party talk. And sometimes it kind of works out. He's a really smart guy. So I was just thinking about that the other day. Wow, I just totally called it. And but I'm pretty much stuck with following the trends and have really been doing it for so long. I just can't even, if I had a really good idea, I don't think I could even implement it if it wasn't a trend following trade.
So how do you handle that? What do you tell people at cocktail parties when they ask you for a market opinion?
Well, it's like you said earlier, it would probably been better off over the years if I had an actual really good story and some good analysis. People kind of prefer that. We're humans. We like stories. We like to watch movies and TV. So I need to have a story for some of these trades. But usually I just tell them the truth. I go with the trend, take small losses. And this is like, my opinion, the secret Wall Street formula. I don't think it's very secret, but diversification and taking small losses. That's really the secret for surviving. And then the secret for marketing is to keep all of that secret and just talk about some story. And maybe another thing CTAs have done over the years is combine PhDs with the trend following. And that's really helped people to create large businesses and raise lots of money, is to make sure the clients knew that it just wasn't these silly breakouts that we were looking at. We have really smart people also giving us information about the right trades to do.
Yeah, the more opaque or esoteric we can make it, it's probably a better marketing plan. But speaking of a great story, you're part of one of the greatest stories ever with the turtle traders. And I know you've talked about it a million times before, but maybe this is a new audience for you. So the idea goes back to the 1980s, where both Richard Dennis and Bill Eckhart were having a conversation. And I believe Richard felt he could train anybody to be a trend follower, and Bill wasn't so certain. But so they decided to put an ad, this is crazy to me, an ad in the Wall Street Journal looking for traders that then they could then hire, which to me, if I saw an ad today saying we're looking for traders, I would think it was a scam, but that's the way it works. But for some background on Richard Dennis, in the 1970s, he allegedly borrowed $1,600 that he turned into $350 million in the markets. So they had this idea that was eventually memorialized called the Turtle Traders with Michael Covell, where they were going to train people to trade Richard's systems and give them money to trade. So you graduate as an accounting major, you're interested in trading markets and everything. You see this ad in the Wall Street Journal. Was just as manna for heaven, or were you concerned it was a scam?
No, I thought it was fantastic. I thought I had randomly just read about trend following and was understanding the basics. And I thought, this is the greatest thing ever. Then I would hear about futures and short trades. And I'm like, oh, yeah, sure. Leverage. I can see that. Shorts, of course, things go down in price. Commodities, more diversification. I just bought the trend following thing, hook, line, and sinker, without listening or talking to anyone. And so then when I applied for the job, was reading the Wall Street Journal. I mean, who even looks at the Wall Street Journal want ads? I don't even know if they still exist now, but they definitely existed in 1983. So I think 1,000 people applied, and they sent out a test. Everyone got a test, true false test, 100 questions, true false. And so I took this test and sent it in, and I got an interview, and I went to Chicago, and finally I ended up getting that job. And it was quite an amazing situation, primarily because Rich and Bill were just genius people. And I had never met people like this before. I had never heard about people like this or listened to people like this before who were so smart. I mean, we thought we were smart. Some of the people there were Harvard Business School and blackjack players and really smart people. And boy, you would just leave meetings with those two and you're just shaking your head like, yeah, I'm not that smart. I mean, these guys were out of sight. And so they really equipped us not just to manage that money and trade for them, but to sort of understand how markets work and how to create an approach that was going to survive. And you could evolve with their rules. And from day one, they were pretty much adamant that, look, you're going to have to evolve. This is not, the philosophies are good, but you're going to have to figure out a way as the markets change to stay alive.
And correct me if I'm wrong, it was like a 2 or 3 week training period, and then they gave you guys $1 million account to trade with?
Yes. I never remember if it was 2 or 3 weeks. It was, yeah. And so one of the funny things is, Rich and Bill, didn't like to wear, a tie, coat or a tie. And so I think their secretary set up this course in a hotel. The Union League Club in Chicago was the only hotel that required you to wear a coat and tie. So that was kind of a funny situation. I don't know if that made it into Covell's books. And then after this 2 or 3 week course, Rich had his Christmas party, and they went around asking us the final exam question, verbal question, and that was, if you hear that Rich is short soybeans, but your signals and your rules that we gave you says that you should be long soybeans, what do you do? And of course, the answer was you stick with your rules. And another huge advantage of that program was not just the rules, but it was the experience with those guys, because we started out trading and we lost money almost immediately. And their bottom line was do the right thing. If you lose money, but you're doing the right trades, don't worry about it. But if you're making money and you're cheating and you're not following our rules, then you could be in trouble. And so this is like a total pretend environment that no client will ever tell you that. Like, just do your trend following. as long as you're doing your method that you've told me about, and there's no style drift, then I don't care if you lose money. Oh, God, no. And the clients, they're like, no, I don't care what you do. Just make money. If you have to cheat a little bit, that's fine. But so it was just this pretend or this amazing environment where we were just being encouraged to be strong and to follow our rules. And it really gave us a good 4 years of being prepared, I think, to have a backbone and stand up to the markets and the clients who are all often encouraging you just to do the wrong things.
Yeah, it's amazing. Like, the blessing you got out of that is not only the strategy, but more important, like, as you know, the discipline and that permanent capital to start with. So you can really learn the discipline over time. Correct me if I'm wrong, but there was 2 primary signals you guys were trading, more of a short, medium term signal, and then like a longer term signal. And that you would get half into the trade on like the shorter term, and then the other you put on the other half if you got into the longer term signal as well.
That's right. And so I think it's a pretty good idea to have a couple of different entries and exits, 2 different systems. And one was longer term than the other, but they were both very short term compared to strategies that work today. Well, trend following strategies that I use that I think works today. But yeah, and the leverage was huge. I mean, I lost about 30% in one day once, but I was up 200% to start the day. So it was like February 1986. So it was just kind of we were using huge leverage, and we had made so much money so quickly, and that was kind of a bad day in the markets. I went home that previous Friday, and I calculated my bonus to be like $1 million. And I was like, this is really, really fun. And then Monday comes, and I gave back quite a bit of that, but this is what Rich wanted us to do. And for the most of the turtles, it was just pleasing Rich. How can we don't want to screw this opportunity up. Here's this guy who gave us the rules, the training, the encouragement, the money to manage, and the nicest people on the planet. I mean, it's just a ridiculous situation that we were all thrown in. And I remember walking up and down the halls to get a Coke or something from the vending machine, and I would pass my colleagues in the hallway, and I would say, we got the greatest job in the world. It's not ever going to be better than this. And they're like, yeah, we know. I'm like, yeah, do not forget this. And Chicago was wonderful. Love living in Chicago. I got there about the same time the Bulls drafted Michael Jordan. It was a total magical time in so many different ways.
What's amazing, though, that you could recognize at a young age that was the greatest job in the world. Most people would be just thinking when they get out of there or whatever, but you were able to savor the moment, which is pretty amazing. And then
it wasn't.
And then I was. Go ahead. Sorry.
Yeah, it wasn't that difficult. I mean,
well, you guys were playing ping pong and going to baseball games in the middle of the day too, weren't you?
That's right. So I went to Chicago. I was a big sports fan, and I was finally moving to a city with professional sports. And the Cubs played their games at 1:20 day baseball. I had no idea what that was about, but they had a few games at 3:00 or so called businessman specials. And so I went up to Rich one day and I was like, okay, so crude closes at 210, S&P closes at 3. What do you think about us going to some of these Cubs games at 3:00? And his response was, we'll go to the ones at 1:20. So this was the atmosphere. It was so far from, hardcore Wall Street. It was just having fun and putting your trades on, and we'd be back there in the back of the room playing ping pong, and then someone would say, we have a trade. So we'd all run to the front, run to our desk and do the trade and put the trade in. Then we'd all come back to the ping pong table. So computer baseball, I got introduced to Bill James, computer baseball. And stories could go on and about how much fun we had. But you had to make money. You had to follow the rules. Not everyone was successful. But I knew it was totally legit when I cashed that first really big check.
And we're going to keep coming back to it may not be a strenuous physical labor job, but the discipline of sticking to your rules is incredibly difficult. And I'm sure we'll keep revisiting that idea. Actually, part of the reason we named our fund Mutiny Fund, there's a lot of reasons, but one of which was an homage to those blue-collar pit traders of the 60s and 70s that were running, high vol strategies and eat what you kill. And, it's an homage to those days and how those things work. But you referenced it earlier. You may have days, a huge up and down swings, and you guys were producing, triple-digit returns. But after kind of the book came out, or you guys went on your own, was that one of the things you focused on first, was position sizing, and maybe you were taking on too much risk?
Oh, definitely. From day one, so I left, the program ended at the end of 87 or the first quarter of 87. And first quarter of 88. So that's when I started Chesapeake, first quarter of 88. And so I kind of knew, I had institutional clients. I had a client. And so I knew that 200% and trying to make 200% and those accompanying volatility and drawdowns was not going to make it. So I know I felt pretty guilty, like Rich is not watching me now. I'm now trading a tenth the size, trying to make 20%. I put that first trade in, and I wasn't doing what, sort of his strategy, which a lot of his strategy was, trade pretty large. But you sort of gravitate into that. But I didn't go immediately to the correct leverage. I think my initial risk was a little too high to start off with. So it just took me a while to sort of get the feeling for what sort of business I wanted to run.
Well, it's a good example. There's the business of managing money, and then there's trading, right? And so figuring out the business you want to run. I think the best part of Market Wizards is you find out there's a lot of ways to make money, but you have to do what works for your personality. And I think that's what you figured out over the long term is work with your personality. I think that if Buffett has a superpower, it's that he's stuck with the same strategy or what works for his personality for all these decades. And you've done similarly. And that is a superpower in itself, was sticking with the strategy. But part of that, did you think, is managing other people's money? You really had to reduce those position size or volatility because it would be too gut wrenching managing other people's money for those swings, or how did you think about it?
It would definitely be too gut wrenching for the clients. Yeah. So, and the whole trend following strategy of infrequent profits and taking small losses, it's just the exact opposite of what most people want. They want frequent profits. The smallest of profits will do. Can I just take this small profit? It just makes us, it's like a drug. We feel so great doing it. But it is suboptimal for maximizing your wealth. So yeah, and nobody believes it like we do, or like I do. And so you're never going to find anybody who can hang in there like the person who's running their system. But even with me, I would lose faith. And the best way to lose faith, put it the other way, the best way to maintain discipline is to trade, to choose a leverage and a volatility that you yourself can handle, so you won't be tempted to violate your rules. And if you do that, you really have a good chance of being disciplined, because that, like you said, that is the most important thing. Even if you don't have the best systematic approach and the best rules, implementing those suboptimal or less than perfect rules, just doggedly, consistently, all the time, and never changing, you're going to come out, close to being on top.
And it's one thing to have that self-discipline, which is incredibly hard for people. But like we talked about with Richard, at first you were getting permanent capital, and now you step out on your own and you're managing other people's money, and you can have really large fluctuations in AUM over the years. So that's a whole other gut check of managing the business of managing money and having huge fluctuations in AUM. Like, how have you dealt with it throughout the years? Because it's got to be incredibly frustrating from time to time.
I don't think I've dealt with it great. I'm not the world's best, pretty average. It's a personal thing. It's even worse than what you said, because it's kind of like, okay, let's look at the monthly returns for the CTA industry. And I'm just like dreading this, personally, because, I want to be number one. I want to finish number one. I want to be up there. I'm very, subject to my competitive desires. And so it's not just losing money. It's not being at the top. So you just need to put all that stuff behind you and really not focus on that. And but it's rare. It's so rare. And I think that's another thing that happens. It creeps in bad rules, rules that help you take profits and not let your profits run. And I think people confuse rules and systematize it and think, well, I have rules, then I'm above reproach. You can't talk to me because I have a rule. What if it's a crappy rule? What if it's like a non-robust rule? It's what I call systematic discretion. I used to sit in front of the quote machine and get nervous about a coffee trade in 1988, I think. And I would just get out of some coffee. Well, there's not a person alive who won't say, well, you shouldn't do that. That's not exercising discipline. Well, CTAs got so much smarter, in the 90s. They just started writing rules for such silliness. Well, if something happens in coffee, if it makes too much money or makes a lot of money or gets too volatile, I'll just take some off the table. And so I think that it's this sort of human desire and how we just really do not like what happens when you follow a trend following strategy. It just has too much volatility. It gives back too much money, although the back test says it makes a lot of money and it's your best shot at making money. And we look at that back test and we're so committed to it. Oh my God, I am going to do this all the time. I have no problem being disciplined. Then when you start having to trade that idea, those systems, so hard, nobody can do it. It's really, really hard to do.
Yeah, that's why paper trading never works, because once you have the money on the line and feel like you want to throw up, that's when the real world kicks in. I'm wondering too about, you referenced the kind of two contradictory points there. So I want to really manage this tightrope. Is that Richard said, you kind of probably need to evolve and adapt over time. Part of maybe trend following is kind of red queen principle. You're kind of running faster and faster, stay in the same place. As you've evolved over time, as markets evolved, you want to maybe tweak your system slightly, but then you want the discipline of not tweaking it to the most, nearest term project. So you're very vocal about you're dubious at backtest. So when you're running a test, you're looking maybe for average wins versus average losses and the right skew of letting those winners run? Or how do you think about adjusting your system at all over the decades?
Yeah, that's a tough question. I mean, I've tried to really look at the systems and make changes to them. I haven't been very successful at finding better ideas. The stop loss we made a little bit larger. I think the turtle stop loss was, the turtle trading in general was shorter term than is profitable these days. So that's basically what has survived all of my tweaks and changes. The only thing that's really survived is just to be longer term. So what I started to do was to look at the charts and look at markets and look at the big trends and see, what are big trends and how far do these markets go? And so I would just put up charts and put breakouts, channels around these charts to see what sort of time frame does it look like with my eyes that would keep me in these trades. And so I'd write those parameters down, and then my computer guys would do the research, and they'd say, "Yeah, that's about right. You're about right." So I think that's the first thing: is you want to not to be too short term, where you keep getting whipsawed in and out, and the market goes a long ways, but you mess up the trend because you want to trade short term and not give back those profits at the end, or too much of those profits. But your first order of business is to get in that trade and not get out too frequently, and then figure out a way when you do that, how you're not going to give too much back. So I like to sort of look at the markets and look at a spreadsheet and come up with some ideas of what I think might work. And then when we do the hardcore back test, we're usually pretty accurate as to what the computer says the best parameters are. I think using all the data. I think using all the data and looking at, and once again, this one entry, one exit, and a stop loss. I think it's just going to stay out of a lot of trouble. The fewer optimizations you have, the fewer parameters. You're not trying to fine tune things too much, but just have a sort of a crude way of staying in these trends. And my gosh, I mean, the last 6 months have just been so amazing. We finally all got reminded as to what really makes trend following. What makes it is these markets. They just take off. They go crazy. And your job is just not to screw it up. And, first of all, do the trade. Most important thing ever is buy those breakouts and don't hesitate. I've left a lot of money on the table by talking myself out of doing trades.
Do you think that part of that too, that over-parameterization and trying to be too cute with it, leads you then to the more rules leads to less sample size, so less confidence you can even have in your win-loss ratio on a back test? Is you want to have the largest sample size of trades as possible, and by over-parameterizing, you might be reducing that sample size, so therefore those returns are fairly spurious?
Nothing more important than that. You said it perfectly. Yeah, there's nothing more important than that. I know Neil's on his podcast, he used to ask people when he interviewed people, individual traders, what is the one question that people should ask you about their trading and their system? And in my opinion, that one question is, what's your sample size and how do you count it? And no one ever asked that question. But no, that's the most important thing. And in order to get a large sample size, you have to have one entry, one exit, and a stop loss. It's not going to get too much better than that. I'm not saying that's the only thing you can use. Like, I think that reducing your positions and reducing your leverage during periods of crisis and to preserve your capital, that's a great rule. It sounds pretty discretionary, but maybe you can come up with a rule for it. And I think you should, in order to, when all hell starts breaking loose, like last February, you need a rule. Let's reduce our risk. This is too crazy. Vols is too high. I'm losing money pretty quickly here. And so I think introducing something like that is a very good idea. It's just not math. It's just not a robust rule. And so introducing non-robust rules to survive, that's fine. This is something that maybe you want to do once every couple of 3 years. But a steady diet of rules, of trades that have a really small sample size, that's not going to help very much.
Yeah, I think some people are upset at Rentec when Simmons stepped in and reduced position size because he was worried about the longevity of the firm, and it wasn't math based. So people got upset with him then, but like, he's just trying to survive. But I'm curious though, when you think about that though, if you're just using like an ATR, an average true range, wouldn't the volatility show up? So then you're position sizing, or you're saying when your open profit's high and volatility comes out of nowhere, that's when you should reduce the book? Or
Right. Yeah, so the losing trades are probably not going to be a problem, because the vol usually doesn't increase very much from when you put a trade on to when you get out of the losing trade. That's pretty easy, but the trend following tends to build up these losing trades and eat away at your capital, 60% losing trades. And then the open trades, they can grow very large, and you have this situation where even if you're making money, you may be, sort of in a capital deficit where you've taken a lot of losses, and if you gave back all of your open profit, you would be down on the year or have a big drawdown. So at some level, you have to understand how all this works and not be afraid to do whatever it takes to survive. And I mean, that's Turtle Rule 101. The first Turtle Rule ever was this cutback. And another primary reason for the cutback rules was doing whatever it takes so you can continue to do the trades, to do the system. So if you're losing money, reduce your positions, reduce your leverage, your future positions for a while so you can keep doing that same systematic approach. And there's no money management rule better than that. But you just need to know that that's sort of a non-system trade. And so non-system trades are not going to help you make more money. I saw someone did a research project on that very turtle idea and came to the conclusion, the turtles would have made more money if they would have just traded smaller. So, yes, exactly. It's so true. Non-system trades, portfolio management, risk management trades, these don't increase your performance.
Yeah, at some point you have a volatility tax to those gains where it's too much if you're running too high a vol. So you need some form of Kelly or betting sizes to make sure you compound wealth more efficiently. But I'm curious how you think about it is like, if you have a right-tailed P&L, like when you're trading trend following, but your biggest trade, your largest open profit, now paradoxically has a large left tail to it. But you have to look at maybe open trade profit very differently from closed trade profit or your actual AUM or NAV point. I'm curious how you think about that or reconcile it while you're in the trade.
Yeah, well, one of the things I learned when I started managing money was that we were taught to look at the trade. So what's going on with this particular trade? So the outlier was a trade. It wasn't a return. It was a trade itself. So if I'm up 100% in a trade or 200% in a trade, and now the trade draws down to 100%, that's an outlier trade. I made 100%. Not I had an outlier give back. So that's always kind of confused me, that a lot of people measure these outliers based upon the daily returns or monthly returns, which, once again, it's eating away at your core philosophy of letting those profits run. If we're going to, and taking small losses, if we're going to define a give back in a big lumber trade as a loss, then how do we let our profits run? So I'm really confused by this. One of the other things too that I think is very important in managing risk is the trade level. And so we were sort of taught and put into practice over the years to not increase that trade level very often. So if we started with $1 million and we made 100% on that million, we would not increase the trade level as we're making that money. We're just going to trade that $1 million initial constant for maybe the whole year, or when those open trades kind of, when we're done with those open trades. So I think the proper management of that trade level and not using your current equity value each day to size your trades, I think that gets people into trouble as well, because those open trades are fleeting. The first Bitcoin trade, I mean, it wasn't a futures, and I didn't take the trade, but I measured it. I think it was 2,000 ATRs, and the give back was 1,000 ATRs. So that trade, I mean, that's pretty manageable. But do not change your trade level of all your other trades as you're making all this money in Bitcoin. You've got to be very careful what you're doing with these, what is your equity? What is your AUM? And what you show in your performance table is usually going to be quite a bit different than how you're managing that money, if that makes sense.
No, it was great. You actually segued and covered my next question, because I was like, how do you deal with the open trade? Do you then new positions, do you put them on at that NAV point, or do you wait for that trade to close? So that was a great answer. And I think about it sometimes, do you ever consider like the traditional prop shops? They ran really tight stop losses, but as soon as guys were running in profit or even close profit, then they would actually open up maybe their trailing stops a little more, take on a little more risk as they were having a positive year. Is that a fair way of looking at it, or did you ever study that?
I wouldn't want to do that because, I have a long list of things that I would never do, regardless of the back test, and that idea would certainly be on the list because I want to be constant. My rules can't change based upon the ups and downs of my equity. So I'm going to risk, 5 ATRs or 4 ATRs, regardless, right? Now I might have a system that's 3 ATRs or 5 ATRs or 10 ATRs, but 3 different systems. But I'm not going to change that parameter based upon some sort of outside forces. I lost my train of thought. But I know for a fact I could not trade at a prop shop.
I don't think there's many of us that could. So thinking about putting on these trades and having a uniform stop loss and uniform position size, uniform from vol from the start of the trade, do you think about percentage max or mins in each individual sector and the correlations of those sectors?
Absolutely. That's another very important process, is to not get too many commodities or too many currencies or stocks or interest rates. So, for instance, I try not to be too, I've done it so many different ways. And most of the things I'm very adamant about these days are things that I have just made so many mistakes on over the years. And getting too intense about correlation and diversification. I trade 100 markets. And so I trade about 50% commodities because I think they're not as correlated in that group. There's energies, there's grains, metals, softs, and then there's some things in the commodity sector that are not correlated to anything. But the currencies are I'm long all the currencies now. That's no fun. I'm kind of short all the interest rate, the bonds now. Until recently, it was hard to find any short equities. So I try not to get too intense about this. And but I do want to use the diversification and be thankful for the diversification. And I've changed my mind about this over the past few years because I want to focus mostly on the outlier. And even if things are highly correlated, you can all of a sudden get an outlier, a crazy move in something that you thought, or that really is highly correlated. In 1990, I made 30% in heating oil, December heating oil. In December of 1990, I made 30% for the year. So it was all in this one trade. And, I think crude and heating oil went back to being 90% correlated shortly thereafter. And so these things can happen. So you kind of are happy that you have crude and heating oil, trading them both as if they're not correlated. That's kind of not totally correct because they're mostly going to be correlated most of the time. But every now and then, silver doubled in 1987 and gold kind of sat there. So that's another thing that the CTAs are doing. We're gently using this diversification, not trying to look too granularly or too intense about it. But we're waiting for something that no one's ever seen before, which can happen, and it can happen in a market that seemingly is correlated to other markets.
And like you said, you want to, the entire key is just to get into the trade and get on the trend. So even if you're in metals and you're trading gold, silver, copper, and let's say they're all in a trend, and so you jump on all of them, are you worried about your aggregate position size in metals, or do you not worry about that anymore?
Well, I mean, I'm worried about everything, but I'm setting up that portfolio, from day one with the weightings and the percentage allocation to each market. And since I'm trading so many markets, over 100, that even if I do get caught in a situation where crude, heating oil, and unleaded, they all go against me, or silver, gold, and platinum, they all kind of go against me. I've got it set up to where it's not going to be a fatal blow. My overall leverage is relatively low. It's 3 or 4 correlated markets out of 100 in some. So, that's kind of how you want to look at it. I think these correlations, too much emphasis is put on correlations. And, you can't change. You're supposed to implement these rules and stick with these rules. And the unit size, or what we call unit size, or what people call portfolio weighting, they should be the same as well. These inconsistencies and these things can creep into your trading where you're like, well, I size based on correlation. So, and I think this is another way that sort of an inconsistent way of trading can creep into your systematic approach, where you're not treating all the trades the same way. And I think this is something that people don't realize sometimes.
The other places where you've been on the vanguard of trend following was you were one of the first people to trade single stock trend following. And obviously it makes perfect sense to me because an index, especially an S&P 500 index, is a trading strategy in itself. And it's an aggregate where you want to disentangle the actual individual components and look for trends both up and downs in single stocks. But I'm curious, though, how you transition to shorting stocks, because it's very different from shorting futures. I mean, a lot of that stuff's kind of baked into the futures price, but shorting stocks is kind of, so it could be viewed as a left skew trade. You have an unlimited downside with only a defined upside. So, and you need to borrow, there's a lot of different moving parts to shorting stocks. So I'm wondering how you kind of incorporated that moving from futures.
Yeah, it's a little bit different. We used to trade single stock futures, but they kind of went away. So now we trade the single names. And so, yeah, I mean, for all the short trades, basically the commodities and the stocks especially, they're not as good as the longs. I think, over the years, and when I was working for Rich, he would say it's okay to add a inferior strategy to your trend following, let's say, if it's going to make money at different times. Now, I never did that. We tried to add different strategies to our trend following, but they just had too much of a negative impact on our performance. We just couldn't stomach it, that this would help with our drawdowns, maybe this other strategy, but we just could not do it. And I think to some degree, that's what shorts are. You're going to make all your money in these longs. At least that's historically the way it's been. I wouldn't rule out the possibility that shorts could have this renaissance. I think that's the right way to think about it from a mathematical sample size point of view. But maybe that's the way that the best I could do for the shorts is, they're kind of a crappy, less than optimal strategy trade. But you know what? They bailed us out. Crude went negative in February of last year. There was a lot of good short trades. That was sort of depended upon how fast you got out of those longs and how quickly you got short stocks and commodities and currencies. That's pretty much how you performed over that COVID period. So I think that shorts are great, and we we do a lot of short trades, and overall they don't make too much money, but they definitely smooth out the performance.
Yeah, they're there when you need them most. It's like we have long periods, right, of the escalator up and then the elevator down. So that's like, it's that punctuated time frames that you really want your shorts. I'm just curious though, like, as you know, correlations kind of go to one in those sell-offs like March 2020. Like, you've ever looked at just being long single names and short like the E-mini index?
I looked at that. I had that as a strategy at one point, but these days and for the longest time, it is very difficult to find shorts that are in downtrends, or stocks that are in downtrends to short. So there's not as many as I'd like usually. But as you said, I never understood why. I think it really hurt the CTA industry to not trade single names. Once again, you were saying, why don't we just downplay the idea of trend following so much and talk about other things? Well, I think I agree with that. We could be a bigger industry. And also if we would have embraced single stocks and versus these indices. So, you're looking for the outlier trade that you may have a chance of getting. If you trade individual names, you can create your own diversified basket of stocks. You can size the stocks based upon the ATR like you do every other trade versus cap weighted. So many reasons that you want to trade individual names. Outliers is probably the biggest reason. And what's trended better over the past 20 years than stocks? Maybe the bonds were great, and stocks, you just have these crazy moves. That Tesla is one of the biggest trades I've ever seen. The Tesla trend has just been 400 ATRs. I mean, that's pretty crazy. So never have understood why CTAs would embrace trading single names.
Part of that Tesla trade makes me think about, like, what's the Pascal quote that, all of humanity's problems come from not being able to sit alone in a room quietly. And it's like the Tesla trade is like sitting on your hands, taking that trend is like, what I find interesting is like the internal dialogue or the internal conflict is like, my trend says I should be long Tesla, but there's a lot of people that have personal opinions about Elon or Tesla. And you're like, I have to close out any personal opinions to just be able to ride that trend.
Oh yeah. I had a Tesla and my wife bought a Tesla for me. And I was like, man, I really don't like Tesla. And I don't like Elon Musk. I mean, he's just too goofy. And people would come up to me in the parking lot of the grocery store and start talking to me about Elon Musk. I'm like, you've got to be kidding me. This is crazy. I don't want to talk about Elon Musk. And so then she gets me this car and I'm like, oh man. And at that time, Tesla was in a big downtrend. And I'm like, you might have known that I would get a Tesla right when the company is going to go out of business. And I think at the time also, it was one of the heaviest shorted stocks, out there. And but I put it in my portfolio for two reasons. Like CTAs do every single market: diversification and liquidity. If you could choose a lot of stocks, but that was definitely one that had lots of diversification and it was certainly liquid. And so buying that breakout, it's just a no-brainer. And so yeah, it's. And same with Bitcoin. I mean, I thought Bitcoin, I like Bitcoin a lot. Bitcoin futures, I bought the original breakout, lost money, bought it again, and it took off. And I thought in some sort of crazy way, Bitcoin was the perfect trade because even in all these other markets, we all have these opinions, but no one understands Bitcoin. No one knows where Bitcoin's going. It makes no sense whatsoever. So we're forced to follow the breakouts and follow the system, so I thought, this is the perfect trend following trade, fairly liquid, very diversified. So I was really happy I got on top of that one.
Well, that's what surprised me is like you're on the vanguard of that, and it's a controversial trade, but it's like, how could it possibly be controversial? It's another trading instrument that's diversified and liquid. You should take it. Like, it doesn't make any sense not to, but it's curious. Yeah. People's personal opinions, tend to creep in, to their trading strategies. So I want to kind of take a slight deviation here and talk about the state of the trend following space currently, or where it's evolved in the last decade. And so part of that, I know we touched on it earlier, but your dislike for vol targeting. But let's talk about vol targeting. I think about vol in maybe three ways. One is when you're putting on a position, right? You're essentially vol targeting that size, right? Using an average true range. The other piece is part of that then is you're going to have a certain amount of, I guess, portfolio vol targeting when you're putting on positions because of those true range and because of recent volatility. But then what you really argue against is the idea once the position's on, you want to really let those winners run, where the industry has evolved to kind of titrate up and down that position using vol targeting to try to monetize that position. And they are likely monetizing too early and reducing those huge right tails of your big winner trades.
You summed it up. That's perfect. I would say one thing that people kind of, it's very elementary, people kind of miss is that because I'm presented with that argument, like, well, if you're going to use the ATR to size your positions and risk, the same number of ATRs per trade, you're sort of vol targeting. Well, and this is not original to me. I don't really know anything about trading that I didn't learn from others, and it's obvious who those others were. But what the whole purpose of the stop loss is to normalize the dollar losses. So that's all we're trying to do. The minute you calculate the ATR and put on the trade, the ATR changes. It gets bigger, it gets smaller, who knows. So that's a losing game to try to think that vol is going to outlast the next 5 minutes. So we just want to normalize our dollar losses. We want to give each trade, X amount of ATRs as a, for a loss. And then we want to make to have that dollar loss in each trade be the same 50 basis points or 30 basis points, whatever it is. So then we're going to hop on our cliche of let those profits run. You're going to let those trade in that particular trade, and we're home free. I mean, it's like a get out of jail card free. And it's almost like the CTAs, instead of embracing that, lowering that bar to say, if it's a profit, you cannot touch me. I don't care how much vol it has. I don't care how it impacts negatively my Sharpe. It is a profit. Oh God, no. No. We got so smart. We had to introduce this whole idea that volatility on an open trade was so negative. It was a problem that we had to correct. And this is the modernizing caveman trend following, was to increase the hurdle on our own self, that we would make it harder for us. And the real dirty secret about vol targeting, the way CTAs do it, is that they're taking small profits. They're taking smaller profits. And so they're taking smaller profits than I will take. Now, the drawdowns are much smaller than mine as well. So that's a good thing. But I've sort of shifted that volatility and that risk and those losses from losing trades to the winning trades. So my winning trades, when we're making tons of money, we're going to see the most amount of volatility, because vol targeting forces you to trade larger because your average profit is going to be smaller. So instead of risking 30 basis points, if I vol target, I might have to risk 50 basis points. And that 50 basis points, that extra additional 20 basis points is, eating away at my capital in a strategy that has 60% losing trades. But the client can hardly see it. It's totally, all the client can see is, well, it certainly looks to me like Jerry is way more risky than all the other traders because he hasn't gotten out of any of his lumber. So it looks that way, of course, but I risked 30 basis points on that lumber trade because I didn't have to take small profits as that on all my trades, especially the big, huge winning trades that make all the money. So I don't know if that's a little confusing, but you've heard that saying, risk doesn't go away. You move it to somewhere else. And I think smarter people than me can probably articulate this better, but that taking volatility targeting does not eliminate the risk that we have in some of these trades.
It makes me think about, the beauty of trend following is it's a right skewed P&L, right? And if you use vol targeting, you may be trying to create a more Gaussian curve, which is inherently a more mean reverting curve, and that's what people are used to. I can't help but think about, decades ago when I used to read, Market Wizards and study up on CTAs, is that if you have this right skewed divergent trades that can do, exceedingly well when you have breakouts, instead of like neutering that trade strategy at all, why wouldn't you combine it with convergent trades, these mean reverting trades that do well when your divergent trades are not doing well? And it's almost rebalancing and scale trading the equity curve between these two divergent strategies. And that would smooth out your P&L over time, because there's got to be times when you're thinking, it's been a year or two since I've had great divergent trades. I would love to have part of my book maybe be in a mean reverting or convergent style trading strategy, but maybe that's anathema to the way you go through life.
I mean, I think it's not something that I want to do, but I fully anticipate that clients would have more of a diverse portfolio, some CTA trend followers, divergence, and then some other strategies like stocks and bonds and things like that that play well with them. But I want to do my part and do it as best I can and be, and that's just the classic trend following. And that's why I haven't really seen the need to add, the mean reversion, carry trade, pattern recognition, short-term trading, et cetera. I've sort of stuck to what I liked and what I wanted to devote my career towards. And I just sort of totally buy into this idea that taking small losses and being maximally diversified and letting those profits fluctuate, those big profitable trades, I just take a lot of comfort in that and not try to worry too much about losing periods. I care about losing trades. I know a client asked me one time, it was like the first quarter of the year, and they're like, the biggest, so we're losing money. And they said, well, do you know your biggest problem in your portfolio? I'm like, no. They were like, well, sugar. And I'm like, well, sugar is a hugely profitable trade. Well, yeah, but it's gone down in the first quarter. You still have a nice profit. So I'm like, I just can't go there with my brain and call sugar anything except a really great profitable trade, irrespective of the fact that it was a bigger profitable trade a few months ago.
But would it be fair to think about your real estate investments are long GDP or implicitly short volatility? So that's a nice ballast to your portfolio holistically at the overarching philosophical level.
What I thought about when you started that question was like private equity. Like, how great would it be if we were like private equity and we didn't have to mark the market? I mean, and conversely, can you imagine someone like private equity who doesn't mark to market? Someone coming in and saying, I've sort of calculated, we have this intern, he's kind of calculated that our open profit in this company that we're going to take public has sold off recently. And so do you think we should get out of some of it? And he'd be shouted out of the room. Are you crazy? We have to maximize this profit. So it all revolves around, who can see the fluctuations. And if you can't see it, it doesn't exist. If you can see the fluctuations in these profits, you must do something about it. You must reduce these fluctuations. It's always the case that when you do the back test and you use this one entry, one exit, one stop loss, and all these markets, and you hold on to these trades, you let them do their thing, and you tweak the parameters, and it comes back and it says, yes, you will make a ton of money. These are great systems, but you will have some volatility. For human beings, that's not good enough. We need to have it done our way. And that's why I've never been very interested in creating a systematic approach that fits my personality, because everything about my personality is wrong when it comes to trading. I want 1% a month. I want ease, comfort, and pleasure. Now, the one part that I do need to pay attention to is my personality for risk tolerance. We've talked about that. I need to get into a situation where my leverage choices are creating a portfolio that allows me to maintain my discipline But apart from that, everything about trading is counterintuitive and is not something that most humans want to do. But I think that is the key. And that's what I was taught in 1983. Do the hard thing. Do the thing that you don't usually want to do. That's your path to evolving and becoming a good trader over time. If everybody wants to vol target, or if everybody wants to take small profits, you kind of know the right thing to do.
And speaking of, we were talking about that vol targeting. Do you think the other thing the industry's done is they've tried to go into asset gathering through growing their AUM? So part of that's vol targeting, is reducing portfolio volatility because that's what the client wants. So part of that is moving away from commodities because they're capacity constrained. So people have primarily moved into financials, and maybe they don't have those commodities to be a ballast to their portfolio if we see, another commodity bull cycle or just more volatility into the commodity markets.
Oh, so true. Having too much AUM is a problem. That's always should be the answer to maximum AUM, and that would be, well, how much can I manage and still make commodities, 40, 50% of my portfolio? And that's the real spice that we add to portfolios. People, when they talk about markets to put into a portfolio, almost all the time what they're saying is what has worked out as a buy and hold. Gold. I could put gold in, I could put real estate in, because I have this analysis that shows if you can buy and hold it. And I think Bitcoin, of course, crossed that line a while back, that now Bitcoin can be included because we can show that Bitcoin has made money buy and hold. We got to hurry up because maybe Bitcoin won't be there one of these days. But and so what the trend following does is it relies so heavily on the commodities and the diversification, but it also allows the commodities to get into the portfolio and the currencies and the bonds, because it doesn't have to be profitable on a buy and hold basis. Trend following creates this profitable trades for almost any market in any sector. It miraculously, Lazarus, it raises these dead markets into markets that not only add diversification and safety for clients, but also contributes profit to the portfolio. So it's so important from a safe point of view. I mean, I look at what we do as just we're the safest. How the hell can the CTA, the trend followers, the futures traders, be the safest portfolio? Not always going to be the best, because we've reached this period where the stocks have done so well for 10 years. But prior to that, CTAs had a better return and a better return risk profile as well. And my guess is we'll get back to that, where we will show our worth once again, as far as a portfolio that is very safe and not subject to some of the sell-offs we've seen in the stocks.
Yeah, it's kind of ironic to me to have such a divergent trading strategy, but then hoping for the mean reversion of multiple decades where it'll come back into profitability at the same time is a great polarity. But my final question to you is a little bit outside the box. Tell me about your passion for fantasy hockey. Where did that come from? Are you trying to Bill James this thing?
Of course I am. That's one of the problems, that when you get involved with systematic trading, Richard Dennis, and you start to see the whole world. You try to cram your whole world into, it must be a rule. We must come up with some sort of rule. I can't hardly even enjoy watching baseball anymore, because I know, these runs created formulas and all the stats and stuff. So a funny story about that is I was in my fantasy hockey league this year, and I decided that I was going to be a long-term trend follower. And so I refused to get rid of some of these players who were underperforming. So I drafted my players only based upon how they performed last year. And so I had a really good team, and inevitably some of the players performed poorly to start the year. I made some good trades on players who had a bad first month after having a great last year. And so I had a really good team. I stuck with it pretty much, and I ended up scoring more points than anyone else. And so then, but I got booted out of the playoffs. I got a bye in the first round, and then I lost in the playoffs. And the guy who ended up winning it had the exact opposite strategy of mine. He looked at the performance over the last few weeks or the past month of players, and he would trade players in and out just based upon this short-term performance. And so I was like, okay, I need to do some more analysis of this. I scored the most points, but this guy really came on. And I think another lesson, of course, I learned was we both just stuck to our strategy. And where other people were all over the board, trying to figure out how to do this, we were both just doing our thing, and we both had really good success. So I think that's really one of the most important things about trading. Well, I asked Rich one time, what's the most important things about trading? And he said, well, trade small and follow your rules. And I can just definitely say that whenever I've underperformed and not done as well as I should have, and I may be the only one who knows some of those periods, and some of them are fairly obvious, though, it's definitely been from one of those two reasons, if not both: trading too large and not following my rules. So,
well, I think that's the perfect spot to end it. And I think about circling back is the idea of wisdom actually comes from sticking with your strategy. And as we touched on in the beginning, I think the highest accolade we could all get is just survivorship. And you've been in the markets for over 4 decades, which is just phenomenal. It's something I aspire to. So I really appreciate your time today, and thank you for being on our podcast.
Yeah, thanks for having me, Jason. It's been fun.
Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com, and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm at Taylor Pearson ME, and Jason is at Jason Mutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.